All right, so we're always hearing about crypto prices shooting up or crashing down, right? But what's actually, making it all work? Today, we're going to get into the nitty-gritty. We're going to pull back the curtain and see the actual mechanics that make this whole thing tick. At its core, crypto was born from trying to solve this one huge puzzle. How can you possibly create digital money that you can send straight to another person, anywhere in the world, without a bank or government giving the okay? And maybe even more important, how do you stop someone from just, copying and pasting that digital money over and over again, just like you would a photo? And that last part, that's the real key here. It gets us right to the heart of the fundamental challenge for any digital currency. It's a problem that has a name: double spending. Think about it. If I hand you a $10 bill, I don't have it anymore, right? Simple. But digital stuff? That's a whole different story. I can email a photo to 100 people, and I still have the original on my phone. So how do you stop someone from spending the same digital dollar, then spending it again and again? Well, the old school way is with a bank. They keep one master list, one source of truth. But crypto's solution, it's something else entirely. So here's the first piece of the puzzle. It's this completely new way of thinking about a database. Forget having one bank control the master record book. What if everyone on the network had their own copy of that book? And what if, for anything to be added, they all had to agree? And that, my friends, is the blockchain. It's what's known as a distributed ledger. Distributed just means everyone has a copy all over the world. And transactions, they get bundled together into these things called blocks. Then each new block gets mathematically handcuffed to the one before it, forming this long, unbreakable chain. And because of that, changing something in the past becomes basically impossible. The key takeaway here is simple. It's shared, and it's permanent. Okay, so let's break down exactly how a new block gets added to this chain. First, you decide to send some crypto. That transaction gets blasted out to the whole network. Then, all these computers on the network check it out to make sure it's legit. Like, do you actually have the money you're trying to send? Once enough of these valid transactions are gathered up, they're packed together into a brand new block. And finally, that new block is cryptographically sealed and snapped onto the end of the chain, creating a permanent record that everyone can see. And that Lego analogy is just perfect for understanding the security here. See, every single block holds a sort of digital fingerprint of the block that came right before it. So if you try to be sneaky and go back to change an old transaction, you'd mess up that block's fingerprint. That would immediately break the connection to the next block, which would break the connection to the one after that. You'd cause this massive domino effect that the entire network would spot and reject in a heartbeat. No way. All right, so we've got this public record book that everyone can see. Awesome. But wait a minute, that brings up a pretty big question, right? How do you prove that your crypto is actually yours and that you're allowed to spend it, especially when you can't just type a password into a public database for the whole world to see? The solution is this brilliant piece of tech called asymmetric cryptography. Basically, you get a matched pair of digital keys. Your public key, think of that like your home address or your bank account number. You can give it out to anyone, no problem. It's how people send you stuff. But your private key, that is top secret. That's like the physical key to your front door or your safe. It is the only thing that can unlock your funds. If you lose it, your crypto is gone forever. And if someone else gets their hands on it, well, they now own your crypto. It's that serious. So, how do these two keys actually work together? It's pretty cool. When you want to make a payment, your crypto wallet takes the transaction details and uses your private key to create a unique digital signature. It's like a one-time use seal of approval. Then you send out the transaction, that signature, and your public key. Now anyone on the network can take your public key and use it to check that the signature is legit. They can prove, mathematically, that it could only have been created by the person holding the matching private key. And the best part? You've proven ownership without ever showing anyone your secret key. It's pure genius. Okay, we're almost there. We've got a public ledger, and we have a secure way to prove who owns what. But there's one last giant hurdle to overcome. You've got this global network with thousands of computers that don't know or trust each other. So how do they all agree on what's true? How do they decide which transactions are good and which block gets added to the chain next? Yeah, in a system with no boss, no central server, how does the network come to a decision? This is what's known as the problem of consensus. There's no visa, no central bank to say, yep, this is the official record. The network has to figure out a way to do it all by itself, to agree on one single version of the truth. So basically, two major solutions have bubbled up to the top. The first one is called proof of work, which is what Bitcoin uses. Think of it as a massive competition. Computers, or miners, all over the world are racing to solve a super difficult math puzzle. The first one to crack it gets to add the next bloke and gets a reward. The security here comes from the fact that it costs an insane amount of electricity and computing power to even compete. Then you've got proof of stake, which is what newer systems like Ethereum use. This one's different. Instead of a race, validators lock up their own crypto. They stake it as collateral. Then the network randomly picks one of them to create the next block. Here, the security is economic. If you try to cheat the system, the network can just burn your staked crypto. It's security through having skin in the game. Now, it's really important to get this. Neither of these systems is perfect. With proof of work, the huge costs have led to a few giant mining pools controlling a lot of the power. And with proof of stake, there's always the worry that super rich players could buy up enough crypto to have too much influence. It's this constant tug of war in the crypto world. But the story doesn't end with just digital money. That was just the beginning. The next huge leap forward came when people started asking, okay, this blockchain thing is cool, but what else can we do with it? What if we could actually program it? And that's really the fundamental difference between, say, Bitcoin and Ethereum. Bitcoin was built to do one thing and do it incredibly well: be a secure, decentralized form of money. People call it digital gold for a reason. Ethereum, on the other hand, was designed from the ground up to be something totally different. It's more like a decentralized global computer that anyone can build and run applications on. The magic ingredient that makes all this possible is something called a smart contract. And really, it's just what it sounds like. It's a contract, but instead of being on paper, it's a piece of code that lives on the blockchain. It's just a bunch of, if this happens, then do that rules. Like, if the concert is canceled, then automatically refund all the tickets. And because it's on the blockchain, it just runs. It's unstoppable, it can't be changed, and you don't need a middleman to make sure it happens. And once you have that building block, it just opens up a whole new world. Smart contracts are the engine behind DeFi, decentralized finance, which is trying to rebuild things like lending and trading without any banks. They're what make NFTs work, proving who owns a digital item and even paying royalties to artists automatically. You can use them for tracking supply chains, letting online groups vote on their own rules. I mean, the list just goes on and on. And this brings us right back to the biggest tension in the entire crypto space today. The whole point, the original dream, was decentralization, a system where no one is in charge. But as it's gotten bigger, real-world pressures, like those giant mining pools or the super wealthy staking huge amounts, are pushing it back towards a more centralized world. So the big question we're left with is, can this technology actually fulfill its original promise? Or will it just end up building the same old power structures, just in a new digital wrapper? That's what everyone's trying to figure out.